Looking for a retirement podcast that covers all aspects of retirement planning? Well, look no further than this podcast. Hosted by me, Nestor Vargas, a certified financial planner, knowledgeable and experienced Latino financial advisor. Each episode features in-depth discussions on a variety of topics, including retirement planning strategies, investment options, tax considerations, Social Security, healthcare planning, and much more. But I also will add a unique twist to the show. Occasionally, I will dive into the considerations U.S. citizens should make when thinking about retirement abroad, exploring different destinations and lifestyles that can be affordable and enjoyable during your golden years. With my extensive knowledge and experience in retirement planning, you'll get the information you need to make informed decisions about your future. So whether you're a Latino looking for retirement planning tips from someone who understands your cultural background, or just someone who wants to learn more about retirement planning, this podcast is the perfect place to start. Tune in today and let's start planning for your retirement with confidence. Is your retirement built on a house of cards? In today's episode, we go over the dangerous territory of current growth, particularly tech stocks, and how they may jeopardize your retirement. So let's get ready for a reality check that may save your retirement. This is your host, Nestor Vargas, certified financial planner and your Latino money man. Welcome back. Bienvenidos to another episode of the Green Cards to Greenbacks podcast, sponsored by Green Mountain Planning, where I help individuals over 50 retire with ease and confidence, and where Latinos can actually find someone who understands their cultural background. Look, before we dive into today's episode, I want to start with a joke because that's what I do. And if you've been following me, I typically like to do Latino jokes, but I've run out of material. So if you have any good Latino jokes, please send them my way. Feel free to, shoot me an email, nestor@greencardstogreenbacks.com. Okay, so it's going to be a retirement joke. You ready? I hope so. All right. So look, regular naps prevent old age, especially if you take them while driving. That's the joke. I thought it was really funny. And you know what? If that was the case, then you wouldn't have to worry about outliving your money. So if you are worried about not having enough money, then maybe taking a nap while driving could prevent you from outliving your money. Obviously, I am joking. Alrighty, so let's go ahead and dive into today's episode. I've got a lot of really great material to share with you, and most importantly, actionable items that you can take. Alrighty, so before we can dive into the meat and potatoes, I think we first need to understand what growth stocks are. And if you've listened to a couple of my prior episodes, I've kind of talked a little bit about growth stocks. They really aren't on top of my mind right now. They're concerning, particularly tech stocks. So growth stocks particularly are stocks of companies that have shown exceptional potential for rapid growth and expansion. And so they often belong to industries that are at the forefront of innovation, and that could be either technology or healthcare innovation or even e-commerce. And really what sets these types of stocks, growth stocks and tech stocks being part of growth stocks, apart from the overall market, it's their ability to expand, to grow much rapidly than the overall market, maybe the S&P 500. Really, obviously, investors love growth stocks sometimes because they're drawn to this crazy explosive growth that can come from being part of, this growth stocks. And it's also kind of like this euphoria, right? It's like being at the forefront or getting the front row seat to witness the success of a company that is building itself up and could be the next giant, right? Now, it's really crucial to recognize that with this great potential for growth, there's also a huge and much higher level of risk. Growth stocks are known for their relatively high valuations, which I'm going to teach you about. And really what that means is that their price often reflects expectations of future earnings. And if these companies miss the growth or that earning that people are expecting, then you see a huge drop in the value of that stock. And if you own some of that, that's obviously going to be your portfolio that's going to feel the pain. So in this episode, I'm going to be shining a spotlight on the dangers of overvalued tech stocks and why they pose a risk to your retirement portfolio. I'm also going to explore the current market conditions, the warning signs of overvaluation is what I want to show you, and kind of really draw some comparisons to historical markets, events like the dot-com bubble that happened in the late 1990s. Look, I am not trying to discourage you from investing in growth stocks or tech stocks altogether. Instead, what I want to do is equip you with the knowledge and tools to assess your current portfolio and make informed decisions. See how much exposure you have to this potential dangerous investments. And what we're going to do is we're going to compare those kind of crazy investments to more of a passive, broader way to invest in the market, like a fund that is called the Vanguard Total Stock Market Index Fund. The ticker symbol is VTSMX. For those of you who do not know what a ticker symbol is, it's like the VIN number to a car. It just identifies the investment. So if you type the ticker symbol into the good old Google machine, that investment will come up and you can learn more about it. Now, I do want to make sure you understand that I will be talking about particular investments today. They're not being recommended. I just want to use some useful information. I want to use actual stuff that we can see so you can understand some of the concepts that I'm trying to talk about. So by the end of this episode, you'll have a clear understanding of your portfolio's exposure to tech stocks and whether it aligns with your, situation or not. It's really time, guys, to take control and ensure that your dreams are built on an actually solid foundation, not on a house of cards. All right. So let's get started. Hopefully, this is going to be an eye-opening exploration of your portfolio and tech stocks and some of those danger valuations and really what steps you can take to better safeguard your financial future. So as we dive deeper into growth stocks, particularly tech stocks, it's really crucial that we're aware of the warning signs and overvaluations. While growth stocks can, like I said, be really exciting, they do have much more risk than the broader market. And so we need to understand how to identify that. And so I want to make sure that we talk about some valuation metrics that I'm going to talk about and actually show you some examples today. And before we dive into those valuations, I actually want to start with an article that I got from Michael Gade, who is a chartered financial analyst, CFA. And that's basically the highest kind of accreditation you can get for an analyst, someone that can tell you about valuations of stocks. Here's what he said. This came in, I think it was 2 days ago. Today is June 1st for the recording of this podcast. He says, the S&P 500 has been lifting the broader market averages throughout 2023. But the artificial intelligence mania spurred on by NVIDIA, which is a company, NVIDIA's Q1 earnings reports it's only a week old. That leaves the open possibility that we're still in the early innings of another tech bubble that ignores all rhyme and reason. NVIDIA now trades at more than 200 times earnings. And even the tech sector as a whole is back up to a forward price to earnings ratio of 27. Don't worry, we're going to talk about what these ratios mean in a second. Just know that they're extremely elevated. Regardless, investors just seem to be back on board of the tech train and are willing to really ride this out until the end of the line when they're literally thrown off. Rallies such as this one that get away over their skis have a good chance of ending very badly. That means there's a lot of risk for FOMO investors, fear of missing out investors, but opportunities for disciplined ones. Almost every non-tech sector of the market is lagging the S&P 500, but that could quickly reverse once this rally pushes too far. So what he's telling us here is that he sees, particularly this NVIDIA tech stock, and there's also other tech stocks, be completely overpriced. And that this tech stocks, because they're so big, they are pushing the overall market up. But the moment that the tech stocks don't meet their mark or their expected returns, then we can be, as a person who's getting close to retirement, already retired, you potentially could be at risk. And so it's really important to understand that and look at your portfolio and say, what do I own? And are the investments that I own heavily, exposed to the sectors? And I'm going to show you how you can do that visually. So for those of you who are not watching this on YouTube, I encourage you to, listen to the podcast if you're driving, but go back to the YouTube video because I'll be sharing my screen. So let's go back to kind of those ratios that we talked about. Price to earnings ratio. The price to earnings ratio is widely used in valuations metrics, and really it compares the stock price to its earning per share. So how much money did each share make, and it compares that to the cost of that share. When the price to earnings or PE ratio is significantly higher than historical averages or its peers, it could indicate that stock prices have become stretched relatively to its earning potentials. We're going to pick on NVIDIA here. Now, the other popular tool or earning ratio is called the price to book ratio. And the price to book ratio is, let me read this here, compares a company's market value to its net asset or book value. So what the market says this company is worth versus really what the company owns, buildings, inventory, all that good stuff. And an elevated price to PB ratio could suggest that investors are valuing the company's future growth prospects more than its actual tangible assets. When this ratio reaches excessive levels, it may indicate over-optimism in the market. Now, another ratio that I'd like to share with you is the TO ratio, or your uncle ratio. And so if you start hearing your friends or your tio or your uncle talk about particular stocks that are, high growth and that they've gotten into it, be really aware, okay? I think it's really essential to remain cautious and avoid getting caught up in the FOMO mentality of investing. All right. Now, I think it's also really important to really draw from lessons of historical market events, right? So the dot-com bubble is a really good event to study and know about. This happened in the late 1990s. During that period, for who maybe didn't experience that, many of you probably have, growth stocks experienced rapid rise in valuations based on expectations of future growth. That was the only reason the stocks were going up. And what happened is that when the reality struck, and earnings failed to match this lofty expectations, then the bubble burst. And it obviously led to significant losses for investors, meaning some investors had to wait a little much longer to retire, or they had a much different lifestyle than they expected if they weren't properly allocated. And this is for real, right? Like, this is not something that may happen or could have happened. It happened. And if you're younger and don't remember this, talk to your grandparents, talk to your parents. They'll tell you about it. So look, by keeping an eye on the warning signs that we're going to talk about and the market's overall sentiment, you can become a better investor. Remember, it's really important to evaluate tech stocks and growth stocks based on their underlying fundamentals and reasonable valuations rather than getting swept away by short-term hype. Alrighty, so I hope this has been helpful so far. Let's go ahead and let's talk about the dot-com bubble a little more, okay? One of the defining characteristics of the dot-com bubble was the astronomical rise in stock prices. And it was really detached. The stock prices were detached from traditional valuation metrics. I'm going to show you an example. Companies with little or no profits were being valued at crazy metrics and really just being valued on expected growth, like hypothetical growth, which is kind of crazy. This phenomenon that happened is strikingly similar to high valuations I see in certain tech stocks today. And, as I talked about, once, companies talk about their earnings, which happens every quarter, they have to kind of tell the investors what the company did on a quarterly basis. Once that happens and the company doesn't meet its mark, then a bubble burst. And so I think it's really important for us to just really understand that. Alrighty. So let me go ahead and talk about some tools. Okay. So what can we do, right? Hopefully I've kind of beat this over the head and have hopefully made a case for why it's important right now. And so I think it's important for me, and what I want to do continue in my podcast episodes is to leave you with actionable steps. Most of you may not want to work with me. In fact, I know most of you may not even ever reach out to me, but I know you're listening. And so I thank you for listening. I want to always leave you with actionable steps. And so we're going to explore some tools that you can use to assess your portfolio's exposure to growth stocks, particularly tech stocks, and compare it to a more passive approach like the Vanguard Total Stock Market Index. Why do I talk about this more passive approach? Because it's really popular. If you invest in this particular way, you really are kind of avoiding the FOMO investing, and also kind of gives you a benchmark to say, okay, here's how I'm invested. Here's how a more passive approach that is widely used is invested, and kind of compare contrast. And if you see something that is completely radically different, then it should say warning flag, what's going on here, and you should be able to articulate what's happening in your portfolio and explain why you or your portfolio is completely deviating from this particular benchmark. And if you have a good reason, then great. And if you don't, then maybe that's time for you to say, well, let me really make some changes. Alrighty. So some of the tools I'm going to talk about, I'm going to give you three tools. Two are free tools. One is a paid tool. The first tool, and I'll leave links to the tools on my show notes, so make sure to go to greencardstogreenbacks.com and then click on the archive button on top of the page and look for this episode. This episode is going to be airing next Friday, so that'll be the June 9th. So you'll see the date there and you'll know that this episode, I don't know what the title is yet. So the first one is called the Fidelity GPS tool, Fidelity Investments GPS tool, Guided Portfolio Summary. I use that tool quite a bit when I worked for Fidelity. It's a great tool. It's a free tool. So if you don't have an account with Fidelity, don't worry. You can just go on fidelity.com, open up a free account. You don't have to fund it, and it'll give you access to the tool. You can manually put in your positions that you may have in your portfolio, whether it be your 401k, your own portfolio, and then you'll be able to kind of do an x-ray of your investment. The next tool is Empower's summary tool. It actually used to be called something different, but now it's Empower Financial who owns the tool. It's also a free tool, really good tool. I haven't used it myself personally, but it's got high ratings, and I know clients who have used it and really like it. In either case, just want to let you know that, when you're using these tools, these companies are probably going to call you, and it's okay. Just expect that call. The third tool is Morningstar's tool. It does cost money. It does have a cost to it, but it is something that you may consider using for a month or two to really analyze your portfolio. Alrighty. So those three tools are great tools. It'll give you enough data for you to really understand what's going on. So at any rate, I don't want you getting caught up in like, which tool should I use? Which one's better? They're all going to give you enough information. Remember that what we're looking to accomplish here is having a better understanding of how much exposure to tech stocks your portfolio has. Okay, so let me go ahead and share my screen. We're going to start with NVIDIA, okay? I talked about NVIDIA quite a lot today. I went to Morningstar.com. I typed in NVIDIA, NVDA. And for those of you who are listening to the podcast instead of watching this on YouTube, I'm going to kind of help you understand what I'm seeing here. We have NVIDIA's valuation tab open on Morningstar.com. And I'm looking at the current price to earnings ratio. Remember, we talked about price to earnings ratio earlier on the show. The price to earnings ratio for NVIDIA currently is 197.05. when compared to the broader market at 19.8. That's right. Nvidia's at 100, trading at 197 price to earnings ratio, where the overall market is the 19. That is a 10x price to earnings ratio, meaning that Nvidia is trading at 10x the price to earnings of the overall market, which is astronomical. Frankly, I mean, Nvidia has always traded a little higher than the overall market because it is a high growth stock. But when we're at 197, that's crazy. Just to give you an example, last year there was trading at a 62. So those are the warning signs, right? Those are the warning signs that you need to really consider. The price to book ratio we talked about as well. Nvidia is at 38 versus the index at 3.58. Again, just crazy stuff. So if you own individual stocks, particularly tech stocks, good thing to do is hop on morningstar.com, type in the ticker symbol, click on the valuation tab. As you can see here, valuation, and then it'll give you that information. Make sure you scroll all the way to the right because that's where the current year is, and then the index column, as you can see. Alrighty, so what I want to share with you here is how I would go at this, analyzing your current portfolio. So let's say you went to the Fidelity GPS tool, or you're using Empower's tool. All of these tools will have different tabs. And one of the tabs that you want to look for is characteristics or sector exposure. Really what you want to do is put your portfolio through an X-ray machine and say, okay, how am I allocated? How much of my portfolio is in tech stocks? How much of my portfolio is in energy stocks? So forth and so on. As you can see here, for those of you who cannot see, I have a internal portfolio that I use, about 90% stocks, 10% bonds. And then I'm comparing that to a portfolio of a prospect that came to me. And what I showed him was the overexposure to tech stocks. My internal portfolio typically has right now is about 90% tech stocks. His portfolio is at 38% tech stocks when he came to me. So we had a really long conversation about this, and I'm glad he listened and said, you know what, this is a warning sign. I wasn't aware that this is what I was doing, and we got a little more diversified strategy for him. So that's the first thing that I would want you guys to look at, is that sector exposure. Maybe you don't have a comparison to my internal portfolio. So that's where I would go ahead and go over to Vanguard's website and type in the ticker symbol VTSAX. So what you'll do is you'll bring up the Vanguard Total Stock Market Index Fund and click on portfolio composition on top of the page. And that will scroll down where it says sectors. And then you'll see, okay, well, like, more passive approach, how much exposure does that approach have versus your portfolio? So the process is that you take your portfolio, run it through the GPS tool, the Empower tool, go to the sector breakdown, understand what percentage of your portfolio is in tech stocks, compare that to a more passive approach. I think a Vanguard Total Stock Market Index approach is just fine. Right now, the index is about 27% tech stocks. If your portfolio is highly more weighted on tech stocks, then warning sign, probably a good time for you to reconsider diversifying into different sectors or different industries to make sure that you're not overexposed to what could potentially be something that either minimizes your current income because your portfolio drops in value, or it just basically takes your retirement date away, pushes it out, and makes you work longer. So that's a little trick that I would consider doing if I were you, in really understanding the risk and making decisions, right? Like, first we understand the risk. We first have to analyze our current situation. The tools are a great way to do that. Then we say, okay, well, what do I compare this to? I think a benchmark is great. That Vanguard Total Stock Market Index, great benchmark to take a look at, and go from there. And if you own individual stocks, then I showed you how to look at individual stocks via morningstar.com and make a better decision. Obviously, the other option, talk to a financial advisor. So I will stop sharing my screen and want to go ahead and, thank you for being with me during this episode. We've reached the end of hopefully what this is an eye-opening journey into the dangers of tech stocks, particularly in this particular scenario, and the importance of assessing your portfolio's exposure. So let's recap the key takeaways from this episode. Like I said, growth stocks can offer exciting potential for growth and high returns, but they also come with risk. It's crucial that you understand the valuation of these companies if you own individual companies, or also crucial to understand how much exposure to tech stocks you have in your portfolio, and understand if you maybe need to cut some of that exposure out and diversify in different markets. We talked about the different tools, talked about Fidelity's GPS tool, we talked about Empower's tool. I showed you some examples of what I put my clients through to analyze their portfolios, or clients or people who want to work with me. We talked about the warning signs of valuations and included elevated price to earnings ratios, price to book ratios, and also talked about your TO's ratio, right? Your uncle's ratio. Look, dot-com bubble serves as a reminder that excessive valuations can lead to market corrections and significant losses. It's essential that you invest with reasonable valuations. It's also essential you understand that I am not saying that we are in a kind of dot-com era, but there's some similarities in particular stocks that you need to really pay attention to. So, take action based on your analysis. If you need someone to do a portfolio analysis for you, most advisors will do it free. I'm happy to do that for you. Make sure you either do the analysis or seek financial advice. Okay. Remember, retirement planning is a long-term process where you can continuously have to keep up with what's going on with your current situation, the stock market, and it really requires a really thoughtful approach. While growth stocks can play a role in your portfolio, it's crucial to strike a balance between potential returns and risk. Thank you so much. Muchas gracias for joining me on this episode. And I really look forward to empowering you with knowledge and tools for a prosperous financial future. Until next time, stay informed, stay vigilant, and make wise investments with your greenbacks. Happy retirement. Take care. Bueno pues. I hope you guys enjoyed this episode. I want to go ahead and ask you to please send me any questions you may have or any topics you want me to talk about. Go ahead and send them to Nestor, Nestor, at greencardstogreenbacks.com. I actually read every email you send, so I'd love to hear from you. Don't forget to head over to greencardstogreenbacks.com for the show notes for this episode and really links to any resources we may have discussed. Bueno, amigos y amigas, nos vemos pronto. Let's go make those greenbacks. This is because of lawyers. You should consult a financial advisor who's familiar with your specific circumstances and of your unique financial life before making any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mentioned rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Nestor Vargas is an investment representative advisor of Green Mountain Planning, a Colorado registered investment advisor.